Hello and welcome. In this lecture video, I'll be talking about accounting for merchandise sales. The last series of lecture videos were about accounting for merchandise purchases. Now we're talking about selling our merchandise to our customers, okay? So remember we talked about back in the first lecture video, the perpetual inventory accounting systems and then the periodic. And what we were saying is that with the perpetual, that each time we make a sale, we update our inventory accounting records. So we update our inventory records, okay? Versus periodic, we make an update to our inventory records at the end of the accounting period when we do our end of period count of inventory, okay? So, but we're dealing with perpetual. So what that means is that each time we make a sale, we have two journal entries. One to recognize the sale and one to recognize cost of goods sold. Now, cost of goods sold is another expense on the income statement. How do we recognize that an expense is going up? With a debit. And then if you think about it, when we're talking about selling our merchandise inventory, we sell our merchandise inventory to a customer. Do we have that inventory anymore? No, we don't. So our merchandise inventory has gone down because we don't have as much anymore. Merchandise inventory is an asset. How do I decrease an asset with a credit? Okay. So let's walk through what I just kind of talked about in terms of this example. So it says right here on November 3rd, Z-Mart sold $2,400 of merchandise inventory on credit. Sold $2,400 worth of merchandise inventory on credit. So what this means, right, is we sold it on credit, which means we don't get cash right away. It means that we have an accounts receivable. Now, where do we put accounts receivable in terms of the accounting equation? Accounts receivable is a current asset. How do I increase an asset? With a debit. So my first journal entry is to recognize the revenue. So that first one, I will debit AR, which is my shortcut abbreviation for accounts receivable. Debit accounts receivable, $2,400. And I'm recognizing that I made a sale. And remember what we talked about back in the first lecture video is that in the context of a merchandiser, we don't call it fees earned. We don't call it consulting services when we make a sale. We call it sales. So I will credit sales. And remember that sales is a form of revenue. Okay. So how does this one keep the accounting equation in balance? Assets are going up, right? Because accounts receivable is an asset, and I debited the accounts receivable, so accounts receivable is going up. Sales is revenue. As revenue goes up, equity goes up. So that's how this journal entry keeps the accounting equation in balance. Let's look at the second journal entry, which is our recognition of our cost of goods sold. Okay, so it says we sold $2,400 worth of merchandise on credit. This is our sale for revenue recognition, which we sold it for $2,400. It says the merchandise had a cost basis of $1,600. This is how much we bought it for from our supplier, plus any normal and reasonable expenditures to get it ready for sale, minus our purchase discounts, returns, and allowances. $1,600 is the cost basis. So we need to use this to do our second journal entry. Okay. Now, cost of goods sold is an expense on the income statement. How do I recognize that expenses are going up? Remember, expenses are costs of doing business. Okay, so how do I recognize an expense is going up? With the debit. So I will debit COGS, which is short for cost of goods sold, COGS, for $1,600. Now, this is to recognize that my cost of goods sold is going up because I sold it. So I have to recognize that my cost of goods sold. Okay. Now, do I have that merchandise inventory anymore? No, I don't. I don't have it anymore. So I have to recognize that my merchandise inventory asset has gone down. How do I recognize that in terms of debits and credits? I credit merchandise inventory because my asset has gone down. Okay. So how does this journal entry keep the accounting equation in balance? Well, assets are going down, expenses are going up, which means that equity, E for equity, goes down. That's how this journal entry keeps the accounting equation in balance. Okay? The difference between these two, the $800 is our profit margin, is our profit on this sale. That's our profit on the sale. Okay? Our gross profit on the sale. So let's look at sales discounts. So what we're saying over here, remember when we talked about the purchase discount that we bought from our supplier, and our supplier said, you know what, if you pay early, I'm going to give you 2% off. If you pay within 10 days or so, I'm going to give you 2% off. That was on the purchasing side. Now we're talking about we make the sale. We made the sale, and we're telling our customers, hey, look, if you pay us early, if you pay us within 10 days, we're going to give you 2% off. Okay? So how do we recognize that? That's called a sales discount. So the sales discount is the mirror opposite of the purchase discount because we're on the selling side. So this is the situation. We sell something, sell some widgets, right? That's always the fun word to use, a widget, product, service, product to our customers. And our customers say, well, we can't pay you now. And we say, that's great. We can still recognize the sale, just like what we did over here. We sold it on credit. That was why it debit to accounts receivable. We can still recognize the sale because of the revenue recognition principle, right? But our customer says, we can't pay you now. We're going to pay you later. And then we say, okay, good, that's fine. If you pay us within 10 days, we're going to give you 2% off, or 3%, or 1%, whatever it is. Okay? How do we recognize that? They see that as a purchase discount. We see that as a sales discount. Okay? Now, a sales discount, right? Let's take a look at that in terms of our journal entry right over here. And again, before we do that, let me just comment on some of these bullets. It says the sales discounts can benefit the seller by decreasing the delay. So this is saying basically, why do we offer our customers a discount for early payment? Because we want the cash. And by getting the cash early, we reduce our operating cycle, and it also makes it easier because we don't have to come knocking on your door on 60 days saying, pay us, pay us, pay us. We get paid early. Okay? Now, when we make that credit sale, right, we don't know if the customer is going to pay within the discount period or not. So we don't know that. Okay? So we're not going to record a sales discount unless the customer pays us within the discount period. Okay? So let's look at two examples right over here. Z-Mart completes a $1,000 credit sale with terms 210 and 30. Okay? So we come over here and we are going to debit accounts receivable, AR, for $1,000, and then we credit sales for $1,000. Okay? Now that's what I'm saying over here is that we're making this journal entry and we don't know if the seller, if the customer is going to pay us within the discount period or not. We don't know that. So we just have to recognize the sale as a credit sale. We sold it on credit. Okay? I have left out the debit to cost of goods sold merchandise inventory here, but that's something that we would also do. We don't know the cost basis and we're only focusing on the sales, and so that's why, for example purposes, only focusing on the sales. That's why the debit to cost of goods sold credit to merchandise inventory is omitted here, but keep in mind that we would have to do that, right? It's a perpetual inventory accounting system. Now let's look at two options. Option one, the customer waits 60 days. So this says you get 2%. We're going to give the customer 2% off. They pay within 10 days. Otherwise, they owe us the full amount in 60 days. So it says option one, customer waits 60 days, right? And then pays the full $1,000, record the transaction. So that means they didn't take the discount. So we could debit cash, $1,000, and then we credit our accounts receivable because we no longer have it from them. They don't owe us any money anymore because they're paying us for $1,000. Okay? Now, let's look at the more interesting scenario where the customer pays within the discount period. Remember, it was 210 and 30. Okay? 210 and 30. So what do we do? How much cash do we get? Well, it's 2% off, 2% discount. So we get 98% of the sale of the $1,000. So how much cash do we get? Number is 1,000. We get cash of $980. Okay. Now we still credit our accounts receivable for our $1,000. Just like what we did before. We credited accounts receivable for $1,000 because they paid us. Now, debits have to equal credits, so I'm missing a debit here. I'm missing a debit. Debits have to equal credits, so I'm missing something. What am I missing? I'm missing my debit to sales discounts. Sales discounts. I'm missing my my debit to sales discounts, which is 2% of the 1,000, which is my $20. Now, where does sales discounts show up on the financial statements? This is another friend of yours, the contra asset. It's a contra account. Not a contra asset, it's a contra account. It is a contra revenue account. And it shows on the income statement. It's a contra revenue account that shows up on the income statement. Okay? What does contra mean? It means opposite. What's the normal balance of sales? Credit. What's the opposite of a credit? A debit. What's in the debit? Okay? And so what we'll see is on the income statement, we'll have our sales minus our sales discounts and returns and allowances equals our net sales. And then net sales minus cost of goods sold equals our gross profit. Okay? So rather than debiting sales, right, which would also reduce sales, rather than debiting sales, we debit this contra revenue account called sales discount so we can track it separately. And then we subtract that number from sales along with returns and allowances to get to our net sales. And then we subtract that number from cost of goods sold to get to gross profit. All right? So sales returns and sales allowances is just like the mirror opposite of our purchase returns and purchase allowances. So sales returns, if you ever bought something from any Amazon or anybody, JCPenney, you have to go return it. That's a sales return. And a sales allowance would be something, we sold it, and then the customer says, well, they're going to keep it, but they want some money off their bill. That's the sales allowance. So it's the opposite of a purchase allowance. Sales return is the opposite of the purchase return. So let's look at our sales return right over here. Recall Z-Mart's sale for $2,400 that had that cost basis of $1,600. Assume the customer returns part of the merchandise on November 6th. The returned items sell for $800 and then cost $600. Record this transaction. 11/6. So what I'm going to do is I'm going to debit another contra revenue account up here called sales returns and allowances for the $800, which is the selling price. Okay. And then I will credit the accounts receivable for the selling price, the $800. That's the first journal entry. Then the second journal entry is I have to recognize that now I have the inventory back. So now my merchandise inventory goes up because they gave it back to us by the cost basis of $600. And then I will then credit my cost of goods sold for $600. Let's look at the sales allowance. Okay, the sales allowance. So assume that $800 is defective, but the buyer decides to keep it, $100 price reduction. In that case, I just debit sales returns and allowances for the $100, and then I credit accounts receivable for the $100. They're not returning the merchandise inventory, so this second journal entry is omitted. Okay, I'm going to end this lecture video now. Thanks.